Imagine this. You've invested in a company that once seemed unstoppable, but now it's teetering on the edge of bankruptcy. How would you even know when to sell before it's too late? Today we're going to be diving into some strategies inspired by legendary investors like Warren Buffett to help you make that critical decision. Stick around to learn how to protect your portfolio from potential disasters. Selling a stock isn't as straightforward as buying one. While there are countless resources and strategies for identifying great stocks to buy, selling requires somewhat of a nuanced approach and understanding of various factors. Now in this video, we'll explore 3 critical scenarios that might prompt you to sell a stock. These will be hypergrowth or overvaluation, the loss of moat, or a change in fundamentals or leadership. Warren Buffett famously said, "Price is what you pay, value is what you get." Now this quote underscores the importance of understanding the intrinsic value of a stock versus its market price. Hypergrowth or overvaluation occurs when a stock's price rises significantly, often beyond its intrinsic value. While seeing a stock you own shoot up in price is exhilarating, it can also be a signal that it's time to reassess its valuation. Now, Peter Lynch offers a similar perspective, warning investors to be wary of stocks with inflated prices, but he also said the key to making money in stocks is to not get scared out of them. However, Lynch also cautioned against holding on to stocks that become significantly overvalued, as this could lead to steep declines when the market corrects. So how exactly do we identify overvaluation? Well, we can use a couple metrics for that. So we can take price to earnings ratios, we can compare the price to earnings ratio of the stock to its industry peers, and a significantly higher PE ratio can indicate overvaluation. Another way is the price to sales ratio. This is a useful way to compare growth companies that may not have earnings just yet, kind of like the PE but without earnings. And the third way would be discounted cash flow analysis. You basically estimate the company's future cash flows and discount them to their present value. Consider the case of Pets.com during the dot-com bubble. The company's stock skyrocketed shortly after its IPO in 1999, despite lacking a sustainable business model or profitability. Investors who recognized the overvaluation and sold early avoided significant losses when Pets.com declared bankruptcy in 2000. This wiped out a lot of shareholder investments. Now on to loss of moat. Buffett popularized the concept of an economic moat, which basically refers to a company's ability to maintain competitive advantages over its peers to protect its long-term profits and market share. Now, he said, in business, I look for economic castles protected by unbreachable moats. Now, a moat basically protects its market share and profitability from competitors. Selling a stock might be wise if a company loses its moat. Now, what are some types of moats? You can have brand strength, which is a strong brand that can command premium pricing. You can have cost advantages, which are companies that benefit from economies of scale. You could also have switching costs, which are products or services that are hard to switch away from. And network effects. These are platforms that become more valuable as more people use them. What are some signs of a weakening moat? This is increased competition. When new or more aggressive competitors erode your market share. You could have a lack of innovation, which is the failure to keep up with technological advancements, but it could also be regulatory changes. You could have new laws or regulations that impact your company's competitive advantage. As for real world, take Blockbuster. They were once a dominant force in the video rental market, but Blockbuster failed to adapt to the rise of digital streaming and to the entry of competitors like Netflix. As its moat eroded, Blockbuster's market share and profitability plummeted. It led to their bankruptcy in 2010. Now, investors who sold their shares before these changes became apparent avoided significant losses. Warren Buffett himself exited his position in IBM after realizing that the company's competitive advantages were weakening in the face of strong competition and the changing industry dynamics. His decision was based on thorough analysis of the company's moat and its future prospects. So sometimes a weakening moat honestly causes a sell. Number 3. Change in fundamentals or leadership. Now, John Maynard Keynes famously said, "When the facts change, I change my mind." Now, significant changes in a company's fundamentals or leadership can sometimes signal that it's time to sell. Now, these could be things like declining revenues or profits. Persistent declines can indicate deeper issues in the company. This could also be increasing debt levels. High debt can strain a company's financial health, especially in interest rate environments such as these right now. Sometimes the industry shifts. Changes in industry dynamics can also negatively affect a company. Now, changes in leadership can impact a company's strategic direction as well, and it could affect their performance. A new leadership team might actually bring in a different vision that sometimes doesn't align with the company's strength or market conditions. Steve Jobs' departure from Apple in the 1980s actually led to a period of decline for the company. Conversely, his return in the late 1990s marked a turnaround. Consider Enron. Once a high-flying energy company, Enron faced significant leadership changes and engaged in fraudulent accounting practices to hide its financial troubles. As the truth emerged, the company's fundamentals deteriorated rapidly. Now, this led to a bankruptcy in 2001. Investors recognized these red flags early, and some sold their shares and they avoided catastrophic losses. Of course, this also involves investors that may have not sold in time. Warren Buffett also emphasizes the importance of trustworthy and capable management. He once said, "When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever." However, if the maintenance team changes and the new leaders are not up to par, it might be time to reconsider the investment. Knowing when to sell a stock is just as important as knowing when to buy. By focusing on key factors such as overvaluation, loss of competitive advantage, and changes in fundamentals or leadership, you can make more informed decisions and protect your investment portfolio. If you like this video, please don't forget to like and subscribe, and I hope to see you in the next one.